Hello Mountaineers, Jordan from Mountway Finance here. This one is for the first home buyers. If you happen to have watched my post from the 30th of September regarding our Reserve Bank announcement, rates on hold that is, and the inflationary pressure that's, in my opinion, going to come from changes to the first home guarantee scheme, this is all about that. Somebody said, what is this first home guarantee scheme? Tell me more about it. And that's what we're going to do today. So here it is in a nutshell, real quick for you. When you go to buy a house, you need a deposit. The minimum deposit that you need generally is 5%. Now, if you go under normal circumstances, it's in fact a little bit more than 5% because you have to pay this additional fee called lender's mortgage insurance if you are borrowing more than 80%. All right, so to be clear, you have a 20% deposit, you borrow 80%, and you fit into a normal category of loan. If you have less than 20% and you borrow more than 80%, your loan is considered to be of higher risk. And that means the lenders need some kind of additional compensation for the risk that they're undertaking with you, the borrower. So they take out an insurance policy on your loan. It's called lender's mortgage insurance, and it's not for your benefit, it's for their benefit in case you default. The insurer will cover them for losses they may incur on trying to recover your loan. So when you borrow at 95%, the lender's mortgage insurance that comes into play there is considered to be high risk. That insurance policy is high cost, and it actually amounts for another 2 to 3, sometimes 3.5% of the purchase price, which means your deposit when you're doing a 95% loan is in fact something like 8.5%. It's a lot more. The point is, it's just another bar that's added on for the first home buyers who are chasing the increases in house prices. They're getting out of reach and they're looking at all the extras that come on top of the deposit that they need to pull together. So they get there, they got the 5%. Then they realize they might have some stamp duty, depending on whether or not they're within the stamp duty concession areas, and most home buyers, first home buyers will. So let's say they've gotten over that hurdle, but then they realise they've got to pay lender's mortgage insurance on top of, so they've got to go back and save another 2.5% or 3.5%. So what the first home guarantee scheme does is it steps in for first home buyers, and it says to banks, we, the federal government, are going to give you a guarantee for up to 15% of the purchase price for this applicant. So whilst they walk into the loan with 5% and you're going to issue them a loan for 95%, we will provide you, the bank, a guarantee for 15%. So you can look upon that loan as if it were an 80% loan, and therefore there's no need to charge lender's mortgage insurance. And yeah, there's some other benefits too. The criteria becomes simpler because there's a set of criteria to get a loan at 80%, and if you thought that was difficult, well, the criteria that comes into play at 95% is actually much more difficult. So we're talking larger buffers are built into the calculations, and some of the rules get tighter and tighter. Some of the, for example, types of income and what kind of extension of that income they will allow starts to fall away. So going to that zone is very difficult. Having the government come in and guarantee 15%, up to 15% of your loan is very beneficial for first home buyers, and it just enables them to get over that bar sooner or with less angst. So that's what the first home guarantee scheme does. It's not the only first home buyer benefit in the mix, and there are many, but it's one of the most impactful, in my opinion. Here's a quick summary of the other ones, just so that we're rounding this out. Firstly, state governments, not federal governments, state governments, they charge stamp duty on every transfer of interest in land that occurs, almost every, but particularly a first home buyer buying a property for the first time from a person they don't know, right? That is normally a transaction that occurs stamp duty. State governments will provide a concession on that stamp duty for first home buyers, and it's usually capped at a certain purchase price. It doesn't necessarily line up with the federal government rules, but it lowers the cost for the first home buyer to get into the market. Now, still on the state governments here, sometimes, well, in fact, all states have this. It's a grant for first home buyers who decide to build. And it's not just building, you can buy off the plan. You can buy a newly constructed house from a builder, for example. Or you can go into, house and land package and that kind of thing. But the idea is that you move into a house that no one has lived in before. And that is a grant. So that's not only a cost saving, it's a cost benefit to you. You actually get money to do that. And that's because state governments want more houses built rather than people just moving into the existing stock and, thereby inflating prices. Specific to new houses. Then we move into some of the federal government schemes. And I just mentioned the first home guarantee scheme. It's now been opened up in terms of its access. So already a pretty useful scheme, which doesn't do anything to address costs except the lender's mortgage insurance thing. But what it really is doing is it's just allowing people to get to that threshold faster. The threshold being a minimum of 5%. So it's providing access is what it's doing. Now, there's some other schemes, and I'm going to talk about just one now, and it's so rarely used, so I can imagine it falling out of favour. But it's called the First Home Guarantee Scheme, and it means you can actually use your super to save money. And the idea is that super is taxed at a concessional rate. So if you contribute money into your super and leave it there for a little bit and then pull it back out of super, you've effectively saved faster because you haven't paid the full amount of tax on that money. Normally you would get paid from your employer, taxed, and then you'd have to try and save what's left. Under this scheme, you get paid, and before you get taxed, some of that money goes into super, but then you pull it out of super later on at a concessional rate. So it still gets taxed, it just gets taxed less. That's the First Home Super Saver Scheme. It really requires some pre-planning, and it's got a few rules and things. It's not very easy to understand if you're new to this kind of thing. So I don't see it very often, but it is there. And then we have this thing which is sort of slated to come into play, but we don't exactly know when. It's co-ownership, right? So the federal government again is looking to implement a program where they will actually go halves or some kind of other type of share in your property, right? So let's say you come to the table with 5%. They might say, well, we're going to come to the table with 15%. We're going to physically pay that money, and then you can get a loan for the 80%. In effect, what that means is your 5% plus the bank's 80%, your money, that's what you owe. So you owe 85% of that property, federal government owns 15%. Now, a lot of people have kind of panned this idea because, who wants the federal government owning part of your property? And there's all kinds of funny rules that come out of this. So for example, you go into this arrangement with the federal government, you live in the house for a couple of years and then you sell it. Now, should they get their money back, or should they get their money back plus the profit that is made on that 15%? Obviously you will pocket the profit on that 15%, but should the federal government get it? I might leave that for you guys to judge, because if they don't, then you collect their profit. So there's no easy answer that makes sense there. But naturally, that one has a lot of problems, right? The other issue is that the federal government is physically forking out money into the Australian property market, and that in itself is a problem. A number of reasons. One of them is that the sort of stakeholders in the system that they're already putting money into. There's kind of like, it goes against this idea that we're all sort of like free economic citizens who are, private ownership of our own assets. I haven't seen it come into play yet. It's been talked about a lot. In the meantime, it seems like the First Home Guarantee Scheme, and being opened up so broadly, is the preferred model to get people into the market faster. Rightio, first home buyers, that's it in a nutshell. Now, I do have some nifty little calculators. that will show you your circumstances, your preferred buying ranges, whatever it is, where you fit in as far as these schemes and what benefits you can get. There's also a guide that sort of goes into very fine detail, all the ins and outs of buying property, building property, the pros and cons, and the benefits available. And if you like, if you want that sort of information, you can get in touch with me, or you can click the link down here. Until next time, catch you later.